Hello and welcome to Portfolio Matters. Before I get going, a quick disclaimer. Please do your own research, etc., etc. Full disclaimer at the end. Okay, this is going to be really quick and dirty, but since I recorded the last weekly talking about the potential impact of the change to CPIH for index-linked gilts starting in 2030, I've had a lot of people get in touch, saying that actually there's already been rises in the yield of index-linked gilts and it is already discounted. Now, I think that's wrong, and I'm going to take you through the maths. So I built a spreadsheet. The bottom line, all you need to know is index-linked gilts, long-dated index-linked gilts, have not discounted the move to CPIH. And if the yield on index-linked gilts, long-dated index-linked gilts, were to move to match the yield on conventional gilts, accounting for the move to CPIH, the price could fall by up to 30%. Now, let me take you through this. I built a simple spreadsheet. Okay, so this is in Excel, and I have chosen two gilts, two long-dated gilts. The T68 is the index-linked gilt. It yields 0.125%. So every year you will get 12.5p of interest for every £100 of it you own. The other gilt I've chosen is TR68, the conventional gilt. It has a yield of 1.625%, i.e. every year for every £100 you own, you'll get £1.62.5. Now, if you hold the index-linked gilt, you will also get inflation, which is, in this spreadsheet, we assume RPI is 3.3%, which is set by the market and by 6-year index-linked gilts. And then from 2030, we're going to assume that CPIH comes in at 2.3%, i.e. inflation doesn't really change, but CPIH comes in 1% lower than RPI, and historically that is what has happened. So in 2068, if you hold the index-linked gilt, you'll get back your £100 multiplied by the indexation, which is 2.85, plus the coupon for that year, which means you'll get back £285.65. For the conventional gilt, you'll get back your principal, £100 plus the interest that year. Okay, now this is the price in the market today. T68 is £55.98. TR68 is £42.87. So if you do an IRR, internal rate of return calculation on those cash flows, the yield on T68, the index linked, is 3.89%, and the yield on TR68, the conventional, is 4.74, i.e. the conventional is yielding 85 basis points more than the index linked. Now, what happens if the market begins to discount the move to CPIH and the yield on the index linked were to move to the yield on the conventional? Well, we can back that out using an NPV calculation. So feeding in the cash flows of T68 and assuming a discount rate of 4.74, you get a price of £39.50. So that means T68 would have to fall by 29.5% to fully account for the move to CPIH. Now, if we assume that CPIH were to match RPI, then the yield on T68 is 4.77%, i.e. it matches the conventional. So what that means is the market has not discounted the move to CPIH at all. It's saying that at the current price, it's assuming you get RPI, i.e. 3.3% for the entire life of the index-linked gilt. But from 2030, it changes to CPIH. That's all you need to know. Bottom line is, as long as the move to CPIH goes ahead, and it's been very well flagged, there's absolutely no question that I'm aware of that that's not going to happen, then index-linked gilts are overvalued and compared to the conventional. And in order to account for the change to CPIH, they need to fall by 29.5% in the case of T68. So the conventional is much better value. That's it. Index-linked gilts are really dangerous by the conventional. Well, that's not advice. We don't give advice, but the conventional is much better value than the index-linked gilt. The index-linked gilts, if and when the market starts to fully discount the move to CPIH, they could fall very sharply on top of the enormous falls they've already experienced. That's it. Do your own research, etc., etc. Full disclaimer coming up. Okay, thank you for watching, and it's goodbye for me, Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.